day, everyone. Thank you for joining us once again here at Seafood and Brew for our briefings. For this briefing, we're going to review over the third quarter performance of that community bank benchmark group. And as you recall, that group is made up of banks with assets between $100 million and $5 billion. Overall, when we look at this performance, we can see that assets grew at 2%, a little more than 2%. And with that, we saw the loan portfolio in total actually decline by a little more than 0.25%. Now, a lot of that decline was due to the PPP loans rolling off and being forgiven. So when we net those PPP loans out, we actually saw a loan growth of 2.71%. So fairly strong, and that's promising as we look into the next year. As for deposits, we continue to see deposit growth strong, and that increased by 2.35% for the third quarter. Looking at the overall level of income, net income increased 3.6%. So very strong in terms of that earnings growth for the community bank benchmark group. Now we translate that earnings into the overall level of return on average assets, and we can see the three primary groups that we follow here inside this community bank benchmark group. We have the sub-S banks, so those are the banks that file under the subchapter S tax purposes, and then we have those stock institutions and mutuals. So overall, we saw the subchapter S institutions decline by about 3 basis points in that return on average assets. The stock group increased by 1 basis point to that 1.09. And then we had that mutual institution group decline from 66 basis points down to 60 basis points. So each of the different groups changed just slightly overall when we're looking at quarter-over-quarter performance. Collectively, though, when we look at the group as a whole group, we can see quarter-over-quarter the average return on average assets increased by about 3 basis points, getting up to that 1.24. However, the median level here for this group dropped 2 basis points, ending at 1.15. So when we're recalling the difference between average and median, average is simply that, just the average of all the institutions, whereas the median is that center point. So, for instance, 50% of the banks in this group have a higher return on average assets of 1.15, and 50% have a lower than 1.15. So that's that median. And whenever we see this divergence grow, that means there's a little bit of skewness. So there are some institutions that had really, really strong return on average assets in the third quarter, which made the average grow faster than we saw the median number grow. But when we look at that average and we do the DuPont model to really get down into the components of return on average assets, we can see the overall differences in where this group, what was pushing this improvement. And overall, we had the net interest income improve by just 1 basis point, so that was a little bit of a bump up. We'll talk about that in a minute. We had provisioning just basically remain stable. Non-interest income, though, increased by 5 basis points, and that's where we saw the most of that improvement quarter over quarter. Collectively, net overhead increased or improved by 4 basis points. So that's where when we're looking quarter over quarter, the biggest movement in the earnings wise contributing to the increase in the return on average assets was that net overhead, increasing that by 4 basis points. But net interest margin did give them a little bit of a bump in that just 1 basis point. So we see that when we look at that net interest margin on a fully taxable equivalent basis. We saw that increase by 2 basis points. I'm sorry, 1 basis point. And that's important that we start to see this stabilize. However, this is looking at the full net interest margin. If we were to back out the additional premium that these banks took in because of the PPP loans rolling off and being forgiven, that core net interest margin likely came down quarter over quarter. So we won't get real good estimates on the true impact in net interest margin until the fourth quarter and probably the first quarter in 2022. But that's something that keep in the back of our mind to remember. Those PPP loans that are rolling off, when they're forgiven, we give, or the bank can take into earnings that the remaining of that premium that they receive. So that's going to give some upward momentum to this net interest margin and kind of skew some of the numbers as we're going through the next several quarters. But with that being said, we can look at the yielding earning assets continues to fall, went from a 365 down to a 360. So we see this continuation, and I think we're going to continue to see that happen throughout the next couple of quarters. We still have assets that are rolling off or repricing at lower rates. So that's something that's going to be a negative when we look at net interest margin moving forward. It's going to continue this margin compression. When we look at cost of funds, that continue to decline down to 29 basis points. The big play on the cost of funds is likely done. We probably have maybe 5 to 10 more basis points to move down over the next year. But I think collectively, banks have been very aggressive in moving down their rates. And I think this is where we're going to end up maybe somewhere around 0.25 the 0.2 in terms of that low point of net interest, cost of funds. When we look at another reason why we continue to see that yielding earning assets decline, this tremendous balance that we have in interest earning cash balances. Currently, we're at 11.56% of total assets. That ratio is much higher than where we were back in the fourth quarter of 2019 when it was just 6.81. So we saw this big run up in this cash, and that cash is only earning about 10 to 15 basis points at best. So we have that really weighing down the earnings potential of these institutions. Net overhead, the next component here, continues to be strong. We can see net overhead down to 1.72%, up just 1 basis points from the prior quarter. But year over year, we can see continued a strong movement. It was 178 in the third quarter of 2020 and 183 in the fourth quarter of 2020. Historically, going back, a net overhead ratio of a 172 would be very strong. But now, since we had a run up in the overall level of assets because of the deposit growth and PPP loans, we saw this come down significantly over the past 2 years. And that's an overall a positive. When we look at the components of net overhead, if you recall, it's the difference between non-interest expense and non-interest income. Non-interest expense stabilized around that 237 quarter over quarter. And then we look at the net or non-interest income, that moved up just 1 basis point to 55 basis points for the third quarter. But overall, the bigger movements have occurred in that non-interest expense. Banks becoming more efficient both in the way that they're operating, but also we've just taken on a lot more in terms of assets and haven't really had to add to our overall expenses during this time. So net positive on net overhead. What about risk? Risk in here has come down a little bit when we're looking at it year over year. On the total side, that's a benefit, but when we look at the components, we can see the overall level capital risk, the capital ratios, because they've been coming down, increased slightly year over year. When we look at credit risk, that has improved overall. We haven't seen the credit issues that we were anticipating at the beginning of the pandemic. So that's an overall positive. However, I will say that the state of the economy, and as we move forward, that's kind of going to see if that washes out and we see some upward momentum over the next 12 months. But for right now, we're good on that credit risk. Liquidity risk, because we have such a large amount of liquidity at banks and in the market, that liquidity risk really improved when we're looking at it year over year. Earnings at risk. This is looking at that sensitivity to net interest margin. And because of the movements in net interest margin, we saw this overall level of earnings at risk increasing here. We're looking year over year. This is going to continue to be the case as we move into 2022 and we continue to see that margin compression. But all in all, when we look at the total level of risk, very little movements there. We had movements in the different components, but overall we're still able to balance that risk. So that's what we have for you this week. We thank you for joining us. Overall, great quarter for our community banks. We hope you the best, and may you have a great fourth quarter. Have a good day, everyone.